Hey, Dr. Goldsmith.
Yeah.
One of the brief exercises I'm having a lot of trouble on is the 16-2.
Okay. We can probably go over that in class.
Okay.
um, Figure out the best way to do that.
Oh, and by the way, I caught up on all the government assignments, and I'm going to take the quiz today. And then I've done a good portion of the intermediate ones yesterday,
Okay,
but I'm
good.
completely caught up in government.
Connect.
And I'm going to try to get caught back up today in intermediate.
I've been opening up that exercise in the solution. That's what my seeming inaction has been involved with. Okay. Thomas mentioned that he had been having difficulty with one of the exercises, so I thought we could begin by taking a look at that. So I'm going to do Now I'm getting distracted because I hear the tornado siren going off. But that's noon on the first day of the month is when they test it here in Hinds County. Now I'm going to do the share screen. So right now you should see what I'm looking at here is brief exercise 16.2, temporary difference. It says Cara Fashions uses straight line depreciation for financial statement reporting and Makers for income tax reporting. 3 years after its purchase, one of Cara's buildings has a book value of $400,000 and a tax basis of $300,000. So what could be confusing about this is these two terms right here. So when it says a book value,
Ako binibili ko meron daw.
what does it mean by that?
The book value, or what are you talking about?
Cara's building has a book value of $400,000. Somebody needs to mute their computer.
What?
So what does it mean by book value here?
Oh, what did I say?
I heard what sounded like gargling.
Javarse, you're on the phone, dude. We don't hear you.
Hold
on. Let's see. So.
Sorry, I called BJ. He didn't know his mic was unmuted.
Sorry,
okay, so y'all are drawing a blank on that. What that means is it's the cost minus the depreciation.
Oh, I didn't hear the question.
Okay, the question was, if you're looking at my share screen right now, you see what I've highlighted in yellow there? It says
Yeah.
the building has a book value of $400,000. So that's its cost minus its accumulated depreciation.
Yeah.
And the tax basis means that that's the cost minus the tax deductions for depreciation that they've taken so far.
Okay.
So this is that there's $100,000 difference because they've taken more, $100,000 more in tax deductions than the straight line depreciation in their accounting records.
So how do you get the deferred tax liability? How do you come up
Well,
with that?
we're not there yet. Because before we go there, I had to make sure everybody understands the starting place.
Okay.
Okay. So that would mean when we look at the solution right here, that there's a timing difference of $100,000. Whoops. That was more sensitive than I thought it was. So this tax depreciation to date has been $100,000 more than depreciation for financial reporting purposes. And that was by comparing the two book values, the accounting book value and the taxable book value. So there's going to be fewer tax deductions for depreciation in the future. they already got a bunch of tax deductions, more than they took on the financial statements. So it's $100,000 timing difference, and the tax rate on that $100,000 is 25%, which is given here.
Can you share your screen?
Is it not, you're not seeing it?
I just see you.
Oh, it's not working properly then because I've got the share screen on. Let me stop the share and go back and start it up again. Because it was, okay, so now I think you're seeing this highlighted stuff here
Yes.
and the 25% there
Yes.
is the tax rate. So now in the solution, we take the timing difference, which is if they have a book value here of 400,000 and a tax basis of 300,000, that's telling us that they took $100,000 more tax deductions for this building than the straight depreciation on their balance sheet. So $100,000 difference times 25% is a deferred tax liability of $25,000.
Hmm?
And that was the amount that they're starting out with this year. So it says the deferred tax liability balance was $20,000 the previous year. There might be something else that I didn't know about that affected it. So what it's saying right here is that the balance was $20,000, but we thought it should be $5,000 or 25 rather, by doing the calculation up here. So they needed to change it by $5,000. So let's go back to the original data. It says taxable income was $4 million. So income tax payable is 1 million because it's 4 million times 25%. Then we've got this difference between what's in the account and what should be in the account. So that's the deferred tax liability. And then the income tax would be the sum of those two. So what they've done here is kind of made it into a puzzle. Normally, when you have this kind of situation in real life, you wouldn't having to be working backwards from these book value and tax basis amounts. You would simply say our accumulated our depreciation expense in the books is this amount this year. Our tax deduction is this other amount, and the difference is the deferred tax liability. So what they're trying to do is to make it into a way of solving a math puzzle.
What threw me off was I was adding the 27,000, or I was adding the liability balance to, I guess, the difference, and I didn't realize the difference times 25% was the answer.
Yeah. So when you do this exercise, compare the book value and tax basis that they give you, which will be different, and then take that difference, multiply it by 25%, and that gives you the desired balance in the liability. Then they will give you the current balance. And so the difference is what you put into the journal entry. Are there questions about that? Okay. And so then the income tax payable, it gives their taxable income tax rate. That should be fairly easy to calculate. And then add the two together to get the amount to debit for the income tax expense. All right, so let's go back to, are there other questions before we go back to pension accounting? If not, then let me open up that PowerPoint. And do the share screen. Okay, now you should be seeing a PowerPoint slide that says factors that change the plan assets. And we went over the 4 factors already. Expected return, the amount of profit expected by the actuary increases the plan assets. So to refresh your memory, the pension plan has all this money that's invested on behalf of the employees. And if those investments are earning money, then there's more, they reinvest it. And so the plan assets increase. Then they want to do this for the long run expected return because you can calculate pretty accurately the long-term expected return on stock market investments to be 10%. On average, if you buy a diversified portfolio and hold it for like 10, 15 years, normally in the past, it earns a long-term increase of 10% per year. But from year to year, it's never 10%. Sometimes it's a loss, sometimes it's a huge gain in the stock market. And so they don't want to have the plan assets actually, the thing that we don't want is for the liability to have to increase because of temporary fluctuations in the stock market. So the actual return is divided into 2 categories: the expected long-term rate of return, and then they subtract from the expected return to get what they call the unexpected return. And then the unexpected return, then if this year was higher than normal, it increases the plan assets. If it's lower than normal, it decreases it. So they add these 2 together to get the actual return. In some years, the actual return could be a complete loss. Possibly this year, that will end up because of the all the things closed down for the coronavirus. On the other hand, depending on what your stock is invested in, you might actually do pretty well this year. During spring break, when we realized we were having to go online, Bellhaven was getting ready to order all the equipment faculty needed to do broadcasts from home. So they're trying to get me a better web camera than the one that's installed on my laptop, which you can see me all right, but it's not high definition and the picture is kind of distorted. Like the door behind me is off at some weird angle. And they wanted to get a better microphone and headset for me. And when they contacted their supplier, they were already completely sold out of all of their broadcasting equipment because everybody was anticipating working at home and bought the stuff. So those kinds of companies may do very well this year. All right, so number 3, payments of benefits, or payments not of benefits, payments by the employer or employees. The book calls these cash contributions, and that's what they invest into the fund. So it's money being transferred from the employer into the pension plan, or by the employee into the pension plan. And that means that there's more money invested in the plan, so it's an increase. Payment of benefits, they have to liquidate an investment to get the cash, and then they pay a retiree part of his or her pension. So that obviously means it decreases the amount of money that's left in the fund. Questions on that? Effects of gains or losses on other comprehensive income. So first we take a look, unexpected gains and losses on pension plan assets. The unexpected gain is reported as an other comprehensive income gain. Unexpected losses, other comprehensive income losses. These are included in accumulated other comprehensive income. So I need to refresh your memory for that. Where in the financial statements would you find OCI gains?
In the income
Income
statement.
statement?
Nope.
The other comprehensive income statement.
Well, it's not a statement of other comprehensive income, it's a statement of comprehensive income. And sometimes I think of it as a statement of other comprehensive income because the only thing that's different between it and the income statement is the other comprehensive income. So the unrealized gains and losses are reported in the statement of comprehensive income. What happens at the end of the year in bookkeeping? What do they do with net income?
Close it.
They close it.
Into what?
Income summary?
And
Or
the income summary is closed in a corporation into
capital?
which capital account?
John Doe? I don't know.
No, that's a partnership or sole proprietorship, not a corporation.
Retained earnings.
Yeah,
Retained
retained
earnings, right.
something like
So the unrealized gains and losses are closed into an account called accumulated other comprehensive income that goes on the balance sheet right next to retained earnings.
that. Okay, hold on. OCI gains go on comprehensive income statement.
Right.
And that
So-
AOCI goes on the balance sheet?
Right. These OCI gains and losses are the changes. And the AOCI is now the ending balance. So maybe I need to open up a real life income company's financial statements for you to take a look at that. Oh, what's a good company? Are you seeing my Google search right now?
Who is that?
Who is what?
Who is the, like, who are they advertising today? Is that polio? Is it polio?
I
The
don't
cure for
know.
It must be the cure
Clothing
for
kind of
polio.
looks like the early 50s when they got the vaccination for polio.
Yeah, it's probably the vaccination anniversary or something.
All right, so let's take a look. Amazon,
April Fools.
Investor Relations, annual reports. The 2019 report's not ready yet? No, that's okay. Okay, where do we look for financial statements? Page 34. Okay, so here is their income statement. And you see here that their net income was for 2018, $10.073 billion.
It's light work.
So statement of comprehensive income begins with the $10 billion of net income, and then they have these unrealized gains and losses.
I remember this now.
Okay, they don't have one for pensions, but they have it for foreign currency translation, available for sale debt securities. And some of them had to be reclassified because of an accounting change. So,
This is the stuff that's this is like the not yet stuff, right?
right. So it's a gain
Okay.
loss that can be measured, but it's not realized because
Hmm.
it's not over with.
Yeah,
Okay.
I remember this.
FASB thinks investors want to know this. So their total other comprehensive loss for the year was $547 million. So now let's go to the statement of stockholders' equity. And notice here that one of the columns in the statement of owner's equity is accumulated other comprehensive income or loss. So that's the third column from the right. And the heading will disappear when I scroll down to the current year. But notice here that our other comprehensive loss that was recorded on that statement is here. This is an accounting change that they had to do. So this came from the statement that showed the changes in comprehensive income. This was the beginning balance. And after the accounting change and this year's loss, the ending balance was $1.035 billion. So now we go to the balance sheet. And on the balance sheet, we see that the ending balance this year for accumulated other comprehensive loss is the $1.035 billion. So actually, what we've seen here is that all four of these financial statements fit together. They call that articulating. So when we're talking here, what we're saying is that the changes, the gains and losses are reported on the statement of comprehensive income. And then the ending balance is on the balance sheet. in the account named accumulated other comprehensive income. Also, the statement of owner's equity shows the changes. Okay, so let's back up and think a little bit about these pension plan assets. What do the assets consist of mostly? Stocks and bonds. Do stocks and bonds change their market value?
Yeah.
Yes. Can it lose market value but gain it back before you liquidate it? Yes. Can it gain market value and lose it before you liquidate it? Yes. So what they've been thinking here is that what's meaningful for planning the pension and how much money the company needs to invest in the pension plan, it shouldn't depend on temporary fluctuations in market value. What they should base their planning on is the long-term expected gain in the investments. And so these temporary fluctuations that are called unexpected gains and losses are not counted as net income gains or losses, but other comprehensive income. And then they go into accumulated other comprehensive income.
So you're saying if it's not a long-term gain or loss, it won't be what it will be on the income statement?
It would, so what we're saying is that this is being reported differently than if it was the company's own stocks and bonds.
Okay.
And the reason for that, these stocks and bonds are not owned by the company, they're owned by the employees. And it's going to be used to finance their pension when they retire. Temporary fluctuations are not helpful for the company when they need to plan how much to invest each year to finance the plan. Their annual investment should be based on the long-term expected gain on the investments. And so they're pulling them apart from each other. They take the actual, remove the unexpected from it, and that leaves the expected gain or loss. So we'll come back to that when we get to some of the numerical examples. Okay, actuarial estimates of the PBO. Remember what that is? We talked about it last time.
Yeah.
If you tell me what it is, I can tell you what it is.
Okay, so what does PBO stand for?
Yes.
Projected benefit obligation. Okay, that was what we talked about here on this slide last time. Projected benefit obligation. That's the present value of the pensions that they've already earned, taking into consideration that their future pension will be based on future salary increases. So that liability is estimated by an actuary. The company that has this kind of defined benefit plan has to hire an actuary, or either full-time or as a consultant, to give them the information that they need. And the actuary does very complex mathematical calculations based on the number of employees that will be getting pensions, how long they'll live after they retire and continue to receive the pensions, what their salaries will be in the future, what is the interest rate that this future liability should be discounted to the present at, all sorts of things like that. So every year, the actuary has to estimate the balance. Some years, they have to change their assumptions on how they do the calculations, and that could change the amount that the actuary says is owed by millions, maybe even billions of dollars. Now, that could be because the interest rates this year are low. It could be because they're high or whatever. Some of these conditions could reverse themselves in the future. And so they're not going to record, if the PBO is suddenly huge or much larger than before, they don't record a loss on the income statement. They record an OCI loss in the statement of comprehensive income. So if the actuary's calculations show that they owe less money, that's a gain. If the actuary's calculations show that they owe more money, that's a loss. Those gains and losses are not reported on the employer's income statement. They're shown as other comprehensive income in the statement of comprehensive income. And then they don't change retained earnings, they change accumulated other comprehensive income. Okay, last time we talked about prior service costs. Those are retroactive benefits. So if the union has demanded that they get more pensions, not beginning today, but beginning 5 years ago, then suddenly the company owes a whole lot more money. And FASB said that they don't have to show that as a one-time loss. They can amortize the cost of it over the remaining average time until employees retire. And so the increased amount they owe is reported as an other comprehensive income loss, and then it's amortized over time. And we'll get to some examples of the calculations for that. Questions before we move on? Unexpected gains and losses on pension plan assets, gains and losses on the PBO accumulate in other comprehensive income. Now, some years they should be having gains on the assets that were unexpected. Some years would be losses. Some years the actuary would calculate a gain on the PBO, other years a loss. They tend to offset each other in the long run. So often these gains and losses tend to wash in the long run. That is, they have about as many gains and losses in the long run, so the balance of this account usually doesn't get very large. If the AOCI balance exceeds 10% of the PBO, so if the accumulated amount on the balance sheet gets too big, then they have to start amortizing it. And they've defined too big as bigger than 10% of the liability. And that shifts the gain or loss out of other comprehensive income, and they record a gain or loss on the income statement. Prior service cost increases are included in AOCI, but they are automatically amortized and are not part of this 10% criteria. So let's go to an example of calculating the PBO for an individual employee. Jessica Farrow is expected to retire in 2049 after 40 years of service. She has worked for the company for 10 years as of December 31st, 2019. Her defined benefit pension formula specifies that her annual pension will be 1.5% times the number of service years, how many years she works for the company, times the final year's salary. The company's actuary projects her salary to be $400,000 at that time.
We are dumb money. We quit our
Somebody needs to mute. Okay, now $400,000 sounds like a lot, but we don't know how high up in the administration Jessica is. And that $400,000 includes not only pay raises, but expected future inflation. So it might actually not be all that high, depending on how bad inflation is. So she'll receive retirement benefits for 20 years. The interest rate to use is 6%. So for this individual, what would the company calculate is the amount that they currently owe her? First step is to calculate the pension benefits that she's earned so far. She has not yet earned the 40 years, just the first 10. 1.5% times 10 years times $400,000 is $60,000 per year. The pension will last for 20 years, so it's an annuity. The present value factor of the annuity at the onset of the retirement, it's an ordinary annuity, 6%, 20 years. So at the time her retirement begins, we use the factor of 11.46992, multiply it by the $60,000, and that gives a liability of $688,195. Then, since her retirement will begin in 30 years, we take the $688,195 and discount it to its present value. Present value factor, $1 30 years at 6%, 0.17411 times the $688,195 is $119,822. So on December 31st, 2019, the employer owes her a pension estimated to be $119,822. So PBO is based on expected future salary, how much of that they've earned so far this year, the pension payout rate, and then its present values. So then if this were the only employee, they would record a PBO of $119,822. But the actuary is going to have to do that for all of the employees. Now, I'm trying to think, I saw recently on the news that Disney World in Orlando closed a few weeks ago, and they said how many employees that they had. And I remember thinking that that was more employees than some small countries, but I don't remember the exact number. So if you had a huge number of employees like Kroger or Amazon or Walmart or Disney, it would be impossible for the actuary to do this individually. It would have to be done on assumptions based on averages for the whole crew of employees. Okay, so we need to go on to this next example. We'll pick up on that one and do it on Friday. I've reached the 40-minute limit, just about. I think it's 45 minutes, but I started before 12 o'clock. So questions about what we've covered, We'll pick up on that exercise on Friday. And note that I'm pretty sure that this is one of your homework assignments. No, that was the brief exercise. Okay, so the brief exercises are even shorter than these ones. And if there's no questions, then I didn't record.
You forgot to record again?
No, I didn't record Javarsi as present
Oh.
or Alex. They see, does anybody not see your name listed? Nancy. And the reason I missed your name is some of you came in when I had started doing an exercise, and so I couldn't see the screen when your names or faces popped up. So, all right then, I'll see you Friday. Email me if you have any problems. That also, most of you are my advisees, and I have not heard from you about registration yet. Don't know why people are procrastinating so much. I don't need to hear that live. So anyway, just please register. All right, see you Friday. Talk to you later. Take care, be careful. Follow the medical advice. See you then.